So we know that we have a lot of startups attending Ecosummit, and it's a new idea that we are presenting a couple of investors in a panel situation where we try to showcase a little bit how smart they are, how good they are at finding new investments, how much experience they have, what they learned in the past, if they are still fundraising, and so on. Let's start. We have Terhi Vapula of Greencoat Ventures. We just heard she made an investment in LumoView. Congratulations, Terhi.
Thank you very much. Super happy to be working with excellent guys.
Why did you invest in LumoView?
There were multiple reasons. So one of the reasons what we believe is that if you look at this is a long story, so cut me short if you need to. But the whole point of if you look at where you need to decarbonize, so of course energy mobility, but buildings are huge problem also, and especially if you only rely on the new buildings, you are in not solving the real issue, which is all the houses which are already there. So addressing that market, the existing, many times very old buildings where you don't have the papers and being able to do it in a smart way. LumoView was obviously a choice for us to address that problem.
Wow. And tell us about your typical ticket size. What is a normal investment for you, a normal first investment?
So maybe a short summary. So we are early stage investor, which for us means seed to Series A plus. We go up to 2 million. In terms of the initial ticket, we reserve very good follow-on so that we can support our companies further. And in terms of the areas, so we are specialists focusing on green transition. And within the green transition, we are also specialists within that field. So we look at solutions which are fast to scale, capital light, typically software. But as you saw with LumoView, you can also have hardware-enabled parts. So that kind of a solution for us. Come and talk to us.
And how big is your fund?
70 million.
And is it finally closed, or is it still open for some new LPs?
So if somebody wants to come, you can still come, but we are closing at the end of the month. So this is very last days we are open.
Okay, last minute ticket to
exactly. Welcome.
You can buy it here, right at Ecosummit.
Exactly.
If you are a hidden LP like me. Matthias Engel of Vireo Ventures, tell us about your investment strategy, please.
Yeah, it's maybe a bit similar. We're also a specialist fund investing into energy tech. We invest typically in pre-seed, seed stage companies across Europe with a minimum ticket of up to 1 million, but obviously having something back in the reserve for all investments. We typically invest into also hardware-enabled software businesses in the energy tech space. But energy tech space for us is pretty broad, so it really starts with energy production, goes all the way to energy transport, storage, all the way to wherever energy is consumed, up to mobility, but also industrial processes, etc.
And do you invest in software only or also hardware?
It is mostly software, but hardware then enabled with software, so a combination of both. We tend to look at hardware opportunities as well, but sometimes figure that monetization, commercialization is far out sometimes. Obviously, we need to return capital to our LPs after 10 years. And we figure that sometimes these companies just will take very, very long and also are very CapEx intensive. So,
Nicolas, tell us about PT1, a brand name that has a bigger meaning than it used to have. Tell us about your investment strategy.
Absolutely. So we are also investing in green transformation of the built world. So we're focusing on real estate, renewables, infrastructure sectors, and technology that makes that more efficient, more sustainable. And we believe this is a very interesting topic, a very interesting place to be in, not just this year, but because of the big transformation happening, but all these new debt packages that we, for example, see in Germany, 500 billion for European resilience and infrastructure. Hey, that's something, right? So there's money to be made. We're typically investing already pre-seed or latest seed, so Series A to enter a Series A would be too late for us typically. We can start in a pre-seed with, I don't know, 500k euros, so taking half of the pre-seed, or in a seed round we could do, let's say, 2 million, 2.5. We like to lead rounds or co-lead rounds because you as the entrepreneurs, you'll know the story. You will find a lot of investors that tell you, cool round, right? Call us when you have a lead investor term sheet. So we are the one, yeah? So we can do lead and co-lead in these stages. There is a lot of hardware involved, so we're not shying away from that. So we believe it's a physical world. Yes, everything has software, and most of the companies have an AI element in, but we need to transform the physical world. And on our platform, which is, I think, a USP, we have a lot of real asset investors, so large funds that invest much larger sums of money into the projects, into the assets. So we can potentially do, I don't know, a 2 million check in a seed round in the top co as a traditional venture investment, but also bring 100 million euros, whatever facility for asset financing. And I think that's an interesting package.
Did you also see the LumoView deal?
Yes, we saw it. I think at least once, maybe even twice. And I totally buy your investment thesis. So we also invested in a couple of these serial renovation startups. One of them, EcoWorks from Berlin, that might be a known name. And EcoWorks is a potential customer, let's say, of them, because they have to do a serial end-to-end process to assess the physical world and then build a more efficient supply chain for serial renovation or serial new builds. And that's a clear necessity because we are running behind the renovation targets in all the Western markets. So we really need to speed up.
And EcoWorks is one of your great portfolio companies.
One of our Fund 1 companies. And so therefore, I think we share a lot of similarities here on stage.
Yeah, cool. The two of you also have a co-investment. Which one is it?
Zero Emission is one co-investment.
And FlexiCharge?
As well. So there's two. Yeah.
Yes. So who introduced which investment to whom? Tell us how this, because I have a theory. The early stage investors are like the truffle picks in the VC value chain. And it is always very interesting to find out how do they find a deal, because they see so many deals. And how do they end up making the deal? But when a deal comes recommended, and you are actually invited into a deal, it is already a special honor, isn't it?
Certainly. So I think working with the other experienced, other VCs in the ecosystem so that we can add value together and more value than just one VC or investor could. So bringing that into the table is something what we strongly believe in. And therefore, of course, you can also get bigger rounds, you can do more things and more support. But on the cases, so at least on Zero Emission, is actually the company from my earlier portfolio from Hella Ventures. So there's a company, Ecosummit, who was also pitching today.
Yeah.
And actually the founder of Zero Emission and the founder of Ecosummit are colleagues from a long time back, being early players in the EV ecosystem. So you kind of get to know that these people are really high caliber and they can deliver and can do what they do. So of course that kind of understanding or getting that kind of insights is at least for us also super valuable. So it's not just the VCs, but it's actually all of you guys. So the whole ecosystem and especially the people who we have already trusted once. So we trust the opinions of those experienced people.
Yeah, and I think we are in close contact with most of the investors, and you kind of share deal flow. You tap certain brains and ask for opinions and reach out to people. So there's a certain engagement, I think, among the community, also among the early stage investors.
Do you already have a co-investment with a PT1, Vireo?
Not really. I think there were a few instances where it might have happened, but I'm sure it will happen in the future.
Absolutely.
Okay. That's the beginning of a new friendship, I can see.
We are friends already.
Yeah, exactly.
But their statistics is 8 out of 10 deals, at least in our fund, 8 out of 10 deals are network deal flow. Yeah? So either coming from a co-investor, from a serial entrepreneur, a business angel, so some trusted source. And correct, as you said, so these deals have a bit of higher priority. in the pipeline, but also statistically, these are the most likely kind of winners in the process. So therefore, always get a warm introduction if you can.
And are the network deals also the ones with the biggest returns eventually?
That's a very interesting question. That's an interesting question. I can't honestly answer that. So the theory is kind of, but I don't have the data to prove it.
Ask me again in 7 years, and I have an answer.
We come back.
Okay.
But actually, I would counter.
Way here when you're on stage again.
But then you need to do 7 more Ecosummits, not only 5. So.
But I think that we are also overestimating the network effects. So I think also one of my earlier portfolio companies, like Inspired, came in as a cold lead. And also the importance of treating every one of those also as a potential star. I think it's important for looking at, of course, through the network, but also directly. And so we can be reached directly. And I actually believe strongly that, or at least we try to do our best on that as well. And then also the deep dives. So investing in companies where we have strong conviction on certain area. And then we try to meet all of those guys who are doing this tiny little box in the value chain and compare how they contrast each other and try to pick the strongest player.
And are you actually going out in the early stage when you do a deep research in an area where you would like to make an investment and add it at the best company, ideally, among several, to your portfolio? Do you go out in the early stage and try to find a pre-seed deal or a seed deal proactively where you are contacting them and you say, we have heard you somewhere with your first press release or even before, somebody told us about you, or nobody told us about you?
Definitely. So especially as we're already investing pre-seed, so we have to be very early by definition. And so potentially there are maybe not other funds already involved, but maybe just business angels. This is also why I emphasize serial entrepreneurs. Of course, it's interesting to know them, so I can give you a case study. So you talked about Inspired, for example. So we invested in TerraOne, which is doing large-scale battery storage systems with an AI-based trading solution for that. And it was 2 co-founders, and one of them was a previous unicorn CFO, Thomas Antonioli, and the other one was a very clever, let's say, tech CTO, CEO, doing energy trading systems all his life, for the big incumbent players. And so when they met, this obviously was interesting, and on top of that, already, 4 years ago, we wrote a white paper on the battery storage tsunami, or however you want to call it, because of different aspects you can describe, with material prices down, volatility in the electricity systems in Europe, and so on and so forth. There is a tipping point now that this asset class is really kind of exploding in a positive way, right? So finding the best team, potentially, from an area, but also looking at the 20 other companies early on with outbound research, that requires some work, right? So VCs are lazy usually, so they try to avoid work, but in that case, maybe it was a good idea. So definitely I'd say a part of the work is outbound deal flow, as we would call it, like research, finding the full peer group, and also then, of course, comparing data a bit, because in every pitch you do, you will always say, I'm the only one, right? You do this XY axis thingy, and you put yourself top right? Everybody, every time, right? And so we talk to 20 similar companies, and then potentially we can make an educated guess who is the subcategory winner, if you want to say so. That should be, I think, the best methodology.
Okay.
But I think the team really is probably the most important topic, especially early stage. I mean, you can have a brilliant idea, you can have the best technology ultimately, and that is a bit textbook what I'm saying, right? So, but in reality, it is the case. If you have the right team that has a bit of more commercial thinking, be able to hustle also on stage, not only attract customers and clients, but also funds, there's good chances that this can be a winning team. Even though maybe technology-wise, they might not have the best solution.
And then there is the interface from the early stage to the later stage, where you are invested in this early portfolio. By definition, it has still a lot of risk. Not all of the portfolio companies make it.
Absolutely.
What about the death rate of an early stage investor? Because why are you actually early stage investors? Because it has a lot of risk. Do you need to be a little bit crazy, or do you need to have a special passion for it, or a special talent for it?
I think you need all of that. So at least for me, I guess it's the capability to look at those solutions which could be truly transformational and which make a difference, and be able to kind of look at where it could, what's the potential, where could this lead into. So I think if you look at the later stage, the numbers will already tell you quite a lot, and probably they tell you also the ones who can't. But in the earlier stage, you need to have more substance matter expertise. At least that's what I believe in. And with that, your insights combined with the unique opportunity which you get into, I really like it in that kind of phase. Of course, yeah, it's higher risk, but then on the other hand is also the highest return. So if you make it right.
I guess the idea is to mitigate some of the risk by being early on, supporting the founders, put them on the right track. And for me, the passion really is being close to founders, work together with them, shape their company, make it successful. Certainly there's no warranty as will happen, but we'll try everything we can, and that's what my passion is. It's not fundraising, to be honest. Yeah, it is really working with the founders, and it's your little baby, and you see how it actually grows up, and it's fantastic to see if we invest, and we've done that even before we started Vireo with our private investments into companies. That we invested to, and there were 5 people. A typical startup. Today, they are 50 people company, had raised a fantastic Series A, and really see how they evolve from really founders to a complete company setup, and that's fantastic to see, to grow like your children that grow up, basically.
There's a lot of, I agree. There's a lot of personal satisfaction you can get out of that. Being close to a bunch of early stage companies, the more you're acting in late stage or like an investment bank or a private equity fund, the more cynical you are, and it's just about the leverage you put in an Excel sheet. It's no longer about the company, the people, the technology. So therefore I really like it. It's, I think, the closest thing. So being an early stage investor is the closest thing that you can do, like being a parallel entrepreneur, which doesn't really exist because it doesn't scale, as we know. And I think the good early stage investors understand that it's of course not them being in the driver's seat, but they can be a sparring partner when needed or when helpful, but also be hands off when it doesn't make any sense. So I think it's a very interesting place to be. If we would just want to optimize for our business model, it would be investing late stage because you have more assets under management times 2% management fee, blah, 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 right? So exactly. The late stage guys think we're crazy. The late stage guys think it's
with a less management fee? Is it good enough to have less management fee?
I think it also avoids problems. Yeah, if you have an 800 million euro early stage fund, however that should work, for example, Atomico, you earn such a shitload of money, so to say, just from the management fee, so all the partners can buy a Ferrari every quarter. So there is no alignment of interest anymore in that chain. So therefore, there is a huge discussion, especially in the US currently, if these super funds really perform, or if the incentive structure doesn't work anymore, because they also get 2% management fee. This is a luxury problem, so we don't have that with like sub 100 million euro funds, right? So every euro we get from the management fee, we pay for a team. And
you are in your second or third fund?
In a second fund.
And what was the fund size of the first one?
The first one was pretty much 50 million. The second one is 65, 70. Ask me again in a month. Also now, taking final checks, until
we do too, by the way.
By coincidence, they all have an open fundraising opportunity. We shout it out to the world. Take notice, please. But and for how many years? Now with your second fund, usually it's a 5-year investment period of one fund, and then
I'd say it's 3 to 4 years is the traditional initial investment period. So this is the time you build up the portfolio, let's say 15 to 20 companies, ballpark. Then there is a cutoff date, and then you, for example, you call 75% of the funds from your LPs, invest that in this first 3 to 4 years. and then you can do a new vintage. So it's a black and white governance usually, so that you don't have two fresh funds on your platform, because then you have a conflict in which fund you put which deal. So ideally, it's just a sequence of every 3 to 4 years a new vintage. I think that's the standard.
And the tricky part is with the fund 2 fundraising, because how much are you measured by LPs, by the performance of your first fund, which by definition cannot be incredibly high, because in terms of exits, I mean,
right?
Because you have book value increases through follow-on rounds, what you can show, but maybe not so many exits because there wasn't enough time to achieve them, right?
Absolutely, but I think a sophisticated LP understands these dynamics, and they will also look at the quality of the valuations. So is this from a third party, objectivized new round? So after us, Google invested at a higher share price and it was a substantial round. Okay, that's a tick, that's okay,
yeah,
right? If it was just a small secondary internally, maybe that's not a good valuation quality, right?
Yeah.
So a good LP will do due diligence on us, yeah? And I'd say, but I agree with you, it's like if you raise your seed round, or pre-seed and seed, you're still telling a story, right? Series A, it's already showing traction, yeah, and still telling a story, but Series B is really tough because you really need to deliver on the numbers, right? So these easy first days, vision, yeah, that's over sometimes. Same for us, of course, right? If we are into Fund 2, Fund 3, we really need to deliver. We need to show that we bring back money to the LPs, otherwise it will be tricky.
Absolutely.
Good. Final round of advice from these 3 great investors. We are starting with Terhi. Which advice do you give the founders to convince you to become their early stage investor? What makes you invest?
I think there are always multiple things, but the team. So you need to have exceptional team. So it needs to be not just good, but exceptional. Because it's super hard to build a good startup. So building it, you need to be smart, diligent, and very fast in execution. So all of those needs to tick. So the team, number 1, show the traction. So that is not just a story. Show what you can show, so we understand that as same thing. So we're also sophisticated investors, so we understand that obviously if you're early stage, you don't have the whole world ready, but show us the early indicators of that traction. And then of course the market. So the market needs to be something where you can truly build a big company. So like looking at the venture model, so it doesn't work for all startups or all companies in general, early companies. So if you are in that mold, and also with that ambition to build that kind of company, those are the 3 key things.
Yeah, I mean, as you said, it's a number of points, obviously, but if you want to have a foot in the door, I would say, show me kind of your commercial thinking, number 1, and number 2, be able to explain in 1 sentence what the product is and who you sell to. Because even that today, unfortunately, is not always clear.
And your favorite advice to enable founders to make you become their long-term partner in an early moment of the career?
As we heard the basics already, I would turn it around. So what is the best advice for choosing the right investor? I think number 1 advice is do due diligence on your investor. And the obvious quick thing is look at the website, there will be 20 logos or something, and just call up 5 of these founders, right? And just get a first-hand reference about if they are really a value-add investor, as everybody claims, yeah, or if they're just giving stupid money, which might be okay if you just want to have stupid money, yeah, so it's also fine. But just check their pitch in a way. I think that's the important thing, because you will have to work together with these guys for 5, 6, 8, 10 years through all the ups and downs, right? And it's almost like, I don't know, like a long-term relationship, yeah, of some kind. So don't do just speed dating, yeah. Take your time to also get to know your investor.
Okay, without further ado, a big round of applause for this amazing panel.